Hi, good morning, good evening. Welcome back to the Dummy Investor channel. This is a place for all retail investors to learn from each other and improve their skills in investing in the stock market. I've been a retail investor myself for quite some time now, and I use this platform to periodically share my personal experience and observations about the state of the market. So for today's episode, as we speak, we are in December 2020 and the markets continue unabated and they are hardly calming down. I mean, yesterday there was some mild correction, but again today as we speak, markets are up. And while all this headiness and exuberance is going on, for beginning retail investors, you'll notice quite a few so-called industry experts and stock market experts start appearing more frequently on the mainstream media and print media talking about how potentially we are at the cusp of a multi-year bull market and it'll be foolish and naive not to go full on and start investing in a market. And basically, my view on that is that we really don't know. I mean, it's possible that we could be in the middle of a bull market. It's equally possible that valuations have run up high, and going forward, we might see either a price or a time correction. And which leads me to today's discussion point. While all this exuberance is going on in the markets. Equity mutual funds have been quietly doing a lot of redemptions in the last, I would say, 2, 3 months, beginning sometime in August. And that's an interesting trend to keep an eye on because usually, if you hear the experts, let me clarify that most of them are just trying to be in the limelight and trying to stay relevant. There are few minority who are genuine experts who care for giving the right advice to people, but most of them actually, if you take what they say at face value or verbatim, you'll probably be misled. Or you'll probably understand it in a very wrong context. And I've been through the same process, and I can clearly say that there's a lot of misinformation out there, and we need to be careful. But just coming back to the point, it's an interesting trend to watch why equity mutual funds have been redeeming their positions in the last few months. And if you hear a typical expert who's into advising retail investors, in their minds, retail investors are naive people or novices who need hand holding. And so, a classic definition of a retail investor is someone who comes when the market has already run up high and tries to time the market, enters at the wrong time, buys at the high point of the market, and then when the market comes down, sells in panic and hence is sitting on losses. Now, I don't have any personal issues with that definition. By and large, I'm guessing that's what how it is, but it's not appropriate or right to paint all retail investors in the same brush. I think there are some that I personally know myself who are really practicing prudent retail investing, and I suspect there are many more out there. And if you see the trend, let me just move on to the next slide, and let me just pull up the um, laser pointer. What this graph shows you is obviously a month-on-month trend beginning April 2019 on how the markets have behaved. So there's BSE 100 and BSE Mid Cap, which are the two solid lines. And the image at the background is basically highlighting the monthly inflows into equity mutual funds, primarily through the systematic investment plan route. and the red graphs actually show whether these are positive inflows or there have been net outflows, which is basically redemptions, right? And I tie it back to the overall theme in terms of how the Association of Mutual Fund Industry has actually, uh, really done a very good job in creating better awareness about investing in equity markets and investing in mutual funds through the Mutual Fund Sahi Hai campaign, which in English language loosely can be termed as mutual fund is always right for you. Now, on the whole, I think it has helped them to expand from just a concentration of a few metropolitan cities in India to maybe potentially tier two cities. And hence, in the last 2, 3 years, you would have seen record inflows into mutual funds. But on the flip side, what it has already done is create a wrong set of expectation amongst first-time retail investors into what equity class, asset classes, and investment is. And many of them came in the last 2, 3 years signing up for SIPs, and then they saw their most of the large cap equity funds actually underperform the benchmark index, either the Nifty or the Sensex. And there has been quite a bit of disillusionment amongst first time retail investors. And my sense is, if you see on the graph, the gray solid line is what the trend of the SIP inflows has been. And so since April 29, it was fairly steady. Then it somewhat peaked in the sort of middle of, or I would say early part of the year. And then obviously there was this dip, and this dip was somewhere around the March, April timeframe when the markets corrected. And gradually it has been a sloping trend line since then. So the inflows have actually reversed as seen by the red graph, and November last month was actually the peak of it. We've got the November data from AMFI, and there were record redemptions last month. And it begs the question why, when the markets are an all-time high and everybody who would have invested uh, would be sitting on some positive gains, that they are redeeming. And I've got some possible reasons for it, but there could be many more. But I thought it'll be a good trend to watch out for, in terms of why retail investors are doing this. So, like I mentioned, in November 2020, the total asset under management was standing around 830,000 crores. And there were redemptions for around 13,000 crores. And not big, roughly 1.5% of the total AUM size. What's interesting to be further observed is whether this trend continues while the markets continue to stay high, or whether this reverses, and really study why investors are behaving this way, right? And so let me move on to the next slide. This is basically a snapshot of the AMFI data, and there are two tables which I wanted to show: section A and section B. Section B talks about the inflows or net outflows into equity-oriented mutual funds. And we see in November there has been a net outflow of 13,000 crores, like I mentioned, and it has been across the board. But on the flip side, interestingly, the inflows into short-term debt funds, liquid funds, long-term debt funds has actually increased substantially. And so it's not as if people are just shunning mutual funds completely. It's just that looks like there is a conscious choice happening between switching capital from equity-oriented funds to more debt-oriented mutual funds. Now, why would that be the case? And so let's try and understand the reasoning behind it. Now, my possible theory for this is there could be 4 or 5 reasons why this is happening. One is, like I mentioned, new investors who signed up for these systematic investment plans through the equity mutual fund route were sort of, I wouldn't say misled, but had their expectations raised wrongly in terms of what kind of returns they can expect from equity mutual funds. They probably thought these are linear returns, just like your savings bank interest or fixed deposit, and which wasn't the case. The last 2, 3 years, up until recently, when the markets have outperformed, most of the large cap equity funds were giving in, returns which are less than even a fixed deposit. And so it begs the question, on one hand, there's this massive campaign on media saying mutual fund say yeah or mutual fund is always right for you, and then the returns were not sort of tying back to that overall messaging. And I think there would have been some amount of disillusionment. So when the markets have actually run up high and people might be sitting on profits, they might just be saying, okay, this is not for me. Let me just book out when there are some profits and just exit the class completely. The other point, sort of like I mentioned, it ties back to the first point that there was a relative underperformance of large cap equity funds in the recent periods up to the run up of this, all-time market high. I also suspect point three might also be at works in the sense there are some seasoned smart retail investors out there who might be booking profits, realizing that the markets have run up. And either booking profits or it ties back to the fact that they might be switching their asset class from equity to debt. I think personally, I am sort of somewhere in it in the sense that I haven't redeemed any equity positions, but at the same time, all my most of my net inflows currently are going into you know debt asset class, and I sort of I am in that category where I feel that markets are richly valued, and probably it's not the best time to deploy all your capital into the markets right now. And so I'm assuming there is a small minority of seasoned retail investors who've sort of been through this ups and down market cycle before, and they probably think this is not the right time to invest in the equity asset class, despite what all these so-called experts are saying that we are in the middle of a multi-year bull run. The other interesting piece is, of course, we've got to also look at alternate asset classes, which is point number five. And you would have seen many state governments in India actually incentivizing people to start looking at real estate market again in a more serious way. They've reduced the stamp duty as a one-time measure. This coupled with the fact that interest rates are coming down or are continuing to stay low, which means that home loan interest rates have become cheaper, and so you're seeing sort of a recent trend of people seriously considering real estate again. And I'm guessing it could be partly because of that. People might be just offloading their equity mutual fund positions and deploying money into what's perceived to be a more tangible asset class, which is real estate. Even though, I have a alternate view on it. The sixth point is basically, I mean, I'm not convinced about this point, but it's possible that smart mutual fund asset managers are raising cash levels again, acknowledging that markets have run up high, and they're positioning their portfolio for a likely, uh, let me say, a correction or future opportunities where valuations could become cheaper. Now, I'm not entirely convinced about this because just the way the mutual fund industry works, very few fund managers actually either have the leeway or the conviction to take a contradictory contrast strand. Most of them are under immense pressure to do the same thing, and there's a herd mentality out there. So you'll see constantly groupthink and people just deploying cash irrespective of market levels. And I have my sort of, I mean, it's possible, but I have my reservations on it. And there could be some other reason as well, which at least I can't think of. So it'll be good if the listeners of this video could pitch in with their views as well and say why this might be happening. So that's all I had to say. These are interesting trends to watch. It looks like there are some either smart retail investors out there who are repositioning their portfolio given the market conditions, or this is just a whole swarm of first-time retail investors who have realized that, they just need to get out of the asset class right now because they've so far had a very mixed experience of were they promised and what has been delivered so far. So if you like this video, please do subscribe to the channel. Please do like the video. Please do provide your feedback, observations on the same topic. And as always, thank you for the time and have a good day.